Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending May 28th, 2021. I'm Preston Brent, and thanks for tuning in. This week's theme is earnings per share versus interest rates. It's going to be a battle in the second half of the year, but before we get started, I want to wish everybody a happy Memorial Day weekend, especially our military members and groups. Pay a special tribute and thanks to all of the United States military personnel worldwide. This weekend is going to be a long holiday weekend for U.S. markets. Monday will be a closed trading day for U.S. markets, which tends to make it a very slow day worldwide. So everybody enjoy the weekend and just spend time with family and friends and make it a good one. So this week's theme, as I said, earnings per share, interest rates. So let's just take a look at where we've been over this past week and just see how things are starting to shape up across the board. Okay. So if we look at the index performance here, you can see everybody was in the green for the week. Even in the year to date, everybody's in the green. The forward PE ratio in the upper right, you can see came in at 22.55. And the dividend yield for the S&P is 1.38, 10-year Treasury 1.58. So that gives us this positive spread of 20 basis points Treasury over S&P. So typically when you see this, as I say, it forces money into the equity markets. The VIX, the prior week was at 20.15, and it fell down to 16.76. So it's not up for the week. It was really down for the week. So vol came in nicely over this past week, even though as we went into close this Friday, markets kind of shifted down just a little bit. The best performing sector for the week was technology, and the worst was utilities. You can see energy is bringing up the best sector for the year so far. Utilities, it's in the green too, but it is the most underperforming sector that we have. Now, looking at this, also the Dow this past week celebrated its 125th birthday. We've seen all of our markets near their all-time highs. Okay, we did see also this week growth shares kind of come back a little bit. I'll talk a little bit more about that in just 1 minute. But we also had, even with earnings winding down, about 86% of the S&P 500 companies reporting have exceeded their earnings per share estimate, which is the highest number that we've seen going back to when I think FactSet was recording this stuff in 2008. So just very, very strong numbers. Okay, I mean everything is coming in really nice. Also, Bank of America put out a note where we had a lot of money, over 156 billion plus, coming into the U.S. equity markets, data flow in. It's one of the biggest rates they've seen since 2012. So we are seeing a lot of money still flow into the equity markets. Now if we look at the economic data, jobless claims this past week fell to a new pandemic era low of 406,000, right? Durable goods increased by 1% in April. Again, more than expected. We did see some slight weakness in regional manufacturing gauges, just a little bit. We're also seeing the unaccompanied minor sippy cup Biden put in his budget of a little over $6 trillion, but they put that in right at the tail end on Friday, going into Memorial Day weekend. Now they did that on purpose to try and bury everything. Markets didn't really pay much attention to it just yet. Republicans came out with their counteroffer on Biden's latest proposal of roughly about 1.7 trillion in spending. Republicans came in at 9.28. I've said the Republicans will probably end up around 1.1 or 1.2 for infrastructure spending. So either way, it's going to be a lot of spending. Okay. And we did see the personal consumption index. That is what the Feds track very closely for inflation. It increased to 3.1% in April, slightly above expectations. This is the biggest increase we've seen in the PACE indicator in 3 decades. Remember, the Feds have a target for this at 2%. So it's going to start to put pressure on the bond market. All right. And speaking of bonds and fixed income, if we do look at U.S. Treasuries, it did pull back just a little bit this week. Okay. And I'm looking at in U.S. investment grade corporate bonds, they're doing very well. The spread between junk and investment grade is very, very tight. So I'm not seeing anything out of whack right there right now. We're still getting solid demand out of Asian markets for our bonds. The other thing that we're seeing, you got to keep in mind, even though we've got interest rates very low, we got tons of stimulus. The one thing that's keeping price action very strong right now is our earnings per share and profit margins. They are out of this world right now. And we're getting a negative real yield, which means that inflation is still a little bit higher than interest rates. So that forces money into the equity markets to get yield, right? Because you take your interest rates that you're getting minus inflation, and right now it's a negative number. And as long as we got this strong earnings per share forward estimate, and remember Q2 is going to come in even stronger than Q1, so that does make tend to move price action higher, right? I mean, we do see that. And of course, if we come over to Europe, we're starting to see them catching up to the U.S. We still have over in Europe still ultra easy monetary policy there as well. Christine Queen Bee Lagarde is the president of the ECB, and she's still into the easy monetary policy thing. Eventually, all of these things are going to have to come to fruition. And when they stop stimulus, we're going to see a reaction in the markets. But right now, everybody's happy campers. Although we have seen Great Britain and the ECB come out and say we're looking at slowing down our stimulus. They're still going to do it. They're just going to slow down the amount. Hadn't really affected the markets that much, but I can see this happening. Now, if we look across Europe, and see how their index performance is one of those rare weeks where everything is in the green there as well, from the Euro stocks index all the way down to the Asian markets with the Nikkei, China, and Hang Seng. Everybody was in the green for the week. Year to date, everybody's in the green. So thus far, markets are looking really good, and as I say, ripe for a pullback. Okay, Chinese stocks pretty much went into the green this past 7 trading days. But we've seen it not only the Shanghai markets, but just doing very strong. We're getting strong home sales out of China. They had one of their strongest gains in China and literally going back 3 months. Okay, but we're seeing strong home sales, consumer spending, and so forth out of China. But China, as you can see, is bringing up the rear there at 3.68 year to date. And you may say, well, why is China doing so poorly when all the other indexes are doing so strong? Because the economic data out of China has been very strong. Remember, they're 90 days ahead of us as far as pandemic issues and opening up, and their data is very strong. And the reason why is that People's Bank of China, they've been cutting back on stimulus, and they've been throttling back their monetary spending and fiscal spending, really. Now, we haven't done that, but this is just going to give you a precursor of what it's going to look like when it starts happening here as well. Okay, so this is some really interesting things to take a look at. What I want to do is shift the screen over, and let's just take you over, and let's look at a couple of key stocks. Let me just see here. And we're going to do an abbreviated session because it is Memorial Day weekend, but I want you guys to get a key into just some macro level insights that I'm looking at here. What you're going to see on the screen here is the S&P 500 E-mini futures. And you can see here that we're setting up for a pretty good little pullback sometime over the summer months. Now, for those of you that have been following me, you know I've been saying anywhere from a 7 to a 12% pullback. It could be even more than that. But I've got an area here that I'm looking at if we do get that pullback, because nothing's ever certain. Somewhere in this range right here, right? You can see this range right here. This would be our pullback range. At the top of that range is a 23.6 fib node. Also sitting right on that range was the closing price of 2020. So below that range, that line there, the blue line, would be in the red for the year. Then there's a natural pivot point right there at 37.20. And then the low for 2021 is at 36.52. So it kind of runs from the high of 37.50 to 3650, roughly in that range, about a 100-point area. All right. So if we get a pullback to that area, what would that represent as far as a percentage pullback perspective? Well, if I just put my little ruler on here, let's just kind of take a look and see. So I'll put it right in the middle there. Right in the middle is right around, I want to say around 13%. If I take it to the top of the level right there, that puts us around 11.3%. So that would be, and notice the 200 EMA is also sitting at 37.20. So that would be what I would expect over the summer months. Now, could it happen next month? We had a strong finish into May. As I said, everybody finished in the green for the week, right? Keep in mind, NASDAQ finished in the red for the month of May. So they had a strong week because NASDAQ came up a little over 2% for this week. Outside of the Russell, is one of the better index performers. But you can see here, we're sitting on the 50 EMA. I think we'll take that out. We'll probably run sideways. Now, understand, momentum is a hard thing to stop. And I would not be surprised to see us run up to the 4,300, 4,350 before we start this pullback. That just means we're going to pull back even more over the summer months. And that would probably push that pullback out to July, August timeframe, maybe into September. And this is just getting right into the same pitch I did last summer. If you guys remember last summer, we were having a pretty good run up off the COVID low. I got all our members along in April. I came out with a list of 10 assets that they should own starting second week in April. And every one of them did doubles. It was an easy pick, right? I don't want to take a lot of credit for it, but these were great stocks. And I just saw that we were starting to get volume and buyers stepping back into the market. Remember, we hit the low March 23rd in 2020, right? So by the second week of April, we were just getting long big time, okay? You could have just closed your eyes and gone long and probably made money. But these were special purpose assets that really did well. Now, so we had just this huge run up, and I was calling for a 10% pullback in the summer months. So we went April, May, June. I was calling for a pullback in June, July timeframe, then July, August, and then we didn't get that 10% pullback till September. All right. And NASDAQ pulled back a little bit more than that. So this time, I believe, I'm calling for the same thing, a pullback, not because of the symmetry of, year over year, but just I do see in the summer months, things are going to get quiet. We may have we will have a strong Q2. The forward guidance in Q2 is going to be a lot weaker than the forward guidance in Q1. And I think that's going to be part of it. Also, keep in mind, in August, the middle of August, we get the Jackson Hole, Wyoming muckety-muck confab. That is when all the central banks get together in Jackson Hole, Wyoming, here in the United States. And I think my gut tells me that Boom Boom Powell, that would be Power Ranger, Jerome Power Ranger Boom Boom Powell, is going to come out and say we're going to be thinking about cutting rates, or cutting stimulus is probably a better way to say it. And every time they've announced that before in the past, going back to 2013, markets always sell off on that. Now, longer term markets move higher. So just because I might be bearish over the summer months or want to turn bearish, to a correction perspective, longer term, I'll still be bullish for now, okay? But things change, markets change, teams change. So right now, I think we can run up a little bit higher, okay? But that'll give us a really strong divergence in the MACD. I think we're going to roll back over, take out the 50 EMA. That's right up here. You can see where we tested it right here. And then we're just going to go lower. Okay. If we look at NASDAQ 100 and just kind of take a look at the chart there and just kind of see how that thing played itself out, you can see here we're a lot closer to the red green line year to date than we are in the others. You can see we cleared this key hurdle right here. It was a key support hurdle right here. And we cleared the 50 EMA also, all right? Now, you can see this is a daily chart. For the past 4 weeks, we haven't gone anywhere. I mean, we've just been running sideways, okay, on these 4 weeks. If we take this out and come back down, we're going to take out the 50 EMA. And you could see we actually came real close to running in the red year to date for NASDAQ going back to May 13th. Okay. So it was just a really interesting time for the NASDAQ 100. And if we look at NASDAQ Composite, which is everybody in NASDAQ, you can see here the same sign, although we're showing a little bit more strength in the NASDAQ Composite than the NASDAQ 100, okay? But still a lot weaker than some of the others. Now, if we look at the Russell, which is leading the way, right? I mean, the Russell is leading the way performance-wise for the year. If we look at that, it actually finished in the red on Friday. We broke this upslope and trend line. We're trying to get back up above. We did get back up above the 50 EMA. But it's showing signs of weakness with this cascading MACD just moving lower and lower and lower. And we're not really going anywhere. You know, if you look at the Russell and we go all the way back to February of this year, we made the big run once we kicked off January. And we actually made the peak in the markets for the Russell back on March 15th. So in the first 12 weeks or first 10 weeks of the year is when the Russell made all its money. And then we've just been since then running sideways to slightly flat to slightly down, right? That's how the Russell performed. Now, I'm going to show you, this is, if you look at this, let's look at IWN. I'm going to show you right here. And this is one of the things that I've talked to our members about. This is IWM. We've been running flat, right? I mean, you can just see going back all the way back to February, it's just up, down. It's just a trading range. That's all we've done. Now, let me show you the Russell growth. These are those companies in the Russell that are growth related. A lot of wide swings, but still going back to February, we're right where we were, okay? Now what I want to do is I want to show you the Russell value. Check this one out. This one is going up. This is the one that I like in the second half of this year to hold us. You can see it held a 50 EMA here. So we did have a big run in growth stocks this past week, but I think value is going to come back in again as there's going to be more pressure, more upside pressure on interest rates. And a good way to play value is IWD, India Whiskey David. You're playing the Russell 1000 value ETF, and it's just running up. I mean, it's just running solid. I like it. We just had a cross in the MACD above zero. I think we're going to keep running up in this. Now, if we do get that 10% pullback coming up in the summer months, have this as on your watch list. Everything is going to go down generally, okay, except possibly bonds. But I want to watch that as well. If we get a pullback in equities and bonds and interest rates go up, it'll be a little bit more dirty as far as the pullback goes, okay. Let's look at the Dow Transports. Dow Transports, again, hit an all-time high on the 10th of May. So early in May, but it's near its all-time highs, okay? And then if we look at the Dow Futures, again, the same thing, holding the 50 EMA near its all-time high. So we want to be bullish, but just understand that we could get a correction here in the next 60 to 90 days over the summer months that could give us a great buying opportunity going into the fall time, all right? So just understand that. If we come over here and we look at volatility, and I got to put my color code back on here, I accidentally deleted it. Vol is coming back into the lows that we last saw in early April, right? We made that big run up here, and then a little bit of a pullback here. And this was all on that CPI data over that 3-day period when CPI reported very high 4.2% inflationary stuff for the consumer. That shows you how sensitive the market is to rising inflation. So when we do get more economic data that shows inflation is going up, if it's really more than expected, just expect some down moves here. And if the Feds jump on top of that by talking about pulling back on stimulus, it could give us that 7 to 12, 13% pullback that I'm looking for in the summer months, right? So that would be an easy no-brainer, I would see. But then use it as a buying opportunity. So you want to go into the summer months with some cash on the sidelines. Okay. If we look at the bond market, it's kind of running flat right now. Notice every time we get over the 50 EMA, the higher probability move is to sell the bonds, right? Short them. And you can see we got over the 50 EMA and we held it for 2 days. 2 days close over, and then we came in just slightly below. My target for the bond market going out into June, July is around 151, which suggests higher interest rates, right? And that to me just seems like a good high prob bet. And obviously the way you'd play that, the easier way to play it, you can short bonds. You could play bonds to the downside. This is TLT, the same thing, or you could look at doing some puts in TLT, right? So I'm looking for a target in TLT from anywhere from 132 down to 130. That would be a good target for TLT, right? So if we do get that pullback, bonds, I'm going to watch bonds very closely to see what happens when equities go lower. Are bonds going to also go lower, or are they going to do the contra move and go higher? Traditionally, they do the contra move and go higher. But if there's some margin difficulty, if there's fear of higher interest rates, and then bonds do move lower, that will, submit that fear in data with interest rates going higher. So we just got to watch it and see. Really hard to tell right now which way it would go. US dollar, well, again, dollar, my target for the dollar was lower here, and I said any move higher in the US dollar should be sold. So if we get up near the 50 EMA or slightly higher, then I would be looking to short the dollar or go long the euro, right? That would be the key. And right now you can see we're in the red for the year for the dollar. We haven't made the 2021 lows yet, but we're in the red. Well, actually we closed just slightly in the green. We're over that blue line. You can see right here, that blue line. That means we're in the green for the year for the dollar, but just barely, all right? And there's the 50 EMA. And as I said, every time we run up to it, you want to be selling it instead of buying it. Of course, if we look at the euro, we want to be long the euro. If we do get that sell-off in the summer, the euro is going to go lower. The dollar will go higher, right? But then you want to use the opportunity to buy the euro or sell the dollar or both, right? So that's a trade that I'm looking at. If we come down here and we look at metals, gold, well, I'm long gold, right? I think I told you guys right over here, you want to be long gold. I was looking for a breakout. We got it. And if we get that pullback and the dollar goes stronger, we may see some hesitation in gold unless we see inflationary fears come in. Then I think that's going to move gold up higher. Longer term, I think gold's going to get back over 2,000 and run. Same thing with silver, right? So we're long gold. We're going to probably be getting long silver. Silver hadn't really gone anywhere for a while. As you can see, it looked kind of like the Russell, just running sideways. It's kind of exactly where it was back in January. But I think silver is going to eventually move out, take out that 30, 35 price and move higher. Okay. Over here, this big spike in silver was when the Reddit group went after it to drive it up. So that to me is just a little bit of noise in the chart. But otherwise, I think we're breaking out of this key area here. Once we break out, like gold, it's going to run, right? Copper, longer term, as you guys know, we've been long copper since the second week in April. That was one of the asset classes that I told our members you got to go long in. Now, China is putting the kibosh on really runaway commodity prices. So that may stabilize copper some because China is one of the biggest buyers of steel and some of the industrial metals like iron ore, copper, all that kind of stuff. But I still think the upside is going to be higher. It's going to eventually get over $5 a ton. This is copper futures. And for our members, we're hedging some downside, but I think this could be a real interesting play longer term. That would be copper, right? So these are just some of the metals and some of the associated miners that go along with these guys I like, okay? If we take a look at oil, well, oil hadn't changed from my original bias. After we made that big run here, I've been saying let's fade the move, and then down in this area here, let's trade sideways, and that still works out. Do I think we could take out 67.98 and run up to 70? Probably so. The momentum can carry us up there, but I don't think it's going to get much higher than that. And then I don't think it's going to get much lower than say 57, 58, which is a big support point here. So the best way to trade this would be unbalanced condors in the oil futures market, or unbalanced flies in the oil futures market. I don't really like trading USO. You don't get the premium and the VIG that you get on trading or the premium that you get in trading oil futures and the premium. So that's kind of where I'd stay. If you want to trade oil, you could trade. I've always liked Devon Energy. It's an exploration and production company. As you can see here, I started talking about it back over here when it was around this level right here, and it's just moved up very nicely. So this is one that's cheap, but I think it can run up even higher. A little bit of a pullback here, but I do like, and there are others that for members I've talked about here that are pretty good. Now there's some other trades that are out here that we're looking at. Members, as you guys know, it's a holiday weekend, so we're not going to have our weekly market watch this Sunday evening, but we're going to pick it up next Wednesday morning with our pre-market trader session, and then the following Sunday with our weekly market watch. I've got some interesting stocks that I want to talk about that'll be part of this supply chain recovery that we're seeing with some industrial build out and some interesting stocks on that. Everybody have a great holiday weekend for the U.S. members. Enjoy it, family, friends, and a big shout out to our military personnel. Have a great time, everybody. I'll see you guys again next weekend. If you're not a member, highly encourage you to come in. All right. I think you'll enjoy it. Make some money at the same time, which is probably even more important. Take care, everybody. Ciao.